There was no easy way to short ESG over the past few years. All you could do was call it out as the sham that it was, which we did in this video over a year ago. It's not that environmental, social, and governance objectives are bad. I mean, we all want better corporate governance, right? And generally, people can agree on what good governance looks like. But the environmental and social stuff, well, people can disagree on that, which is why every company claims to be very ESG. Wall Street found ways to disingenuously make money of this infatuation. You could get an ESG rating just like a credit rating. And because the criteria was so, well, flexible, it turned out that almost every company had strong ESG credentials. In fact, BlackRock's iShares ESG fund with the ticker ESGU is so similar to the S&P 500 that the two almost perfectly track one another, except that ESGU charges a higher fee. They're smart. BlackRock never actually believed ESG-rated companies did better than the S&P 500. That's why their ESG fund looked so much like the market itself. But they did understand that gullible investors would pay more for a fund that styled itself as ESG. So once again, you have the gullible doing business with the cynical, and we know who comes out best from that matchup. My favorite is the Dow Jones Sustainability Index, which includes Lockheed Martin, a vital company to be sure, but how can a sustainability index include a company that builds fighter jets and bombs? Reality is spreading, and ESG funds are losing assets, as of course they should. The Wall Street Journal reported that over $14 billion has been pulled from ESG funds this year. Greenwashing is when companies misrepresent their ESG credentials. A study by InfluenceMap recently found that 58% of big companies lobby for regulations and laws that are in conflict with their stated goals on CO2 emissions. This shows that most big companies look at ESG as something they must pay lip service to, but not something they want to adopt. Peabody Energy is America's biggest coal producer. If the world wants to reduce CO2 emissions and harmful pollution, then coal is the place to start. Peabody produces an ESG report. Of course they do. Every big company does. Because every company has an ESG story to tell. And if everybody is ESG, then it's pretty meaningless. You might as well say you're the nicest company. Hey, I think I'm the nicest fund manager. If Dow Jones ever wants to make an index like that, I'm sure I could find objective ways to show how nice we are. I'd start with my mother and move on from there. It's a regular cycle in investing that the naive and gullible are separated from their money by cynical fund managers and service providers happy to profit by giving people what they want, even if it's a dumb idea. We've never been an ESG manager, even though the energy sector, where we invest, is well represented in ESG indices. BlackRock, who runs ESGU, says they are the biggest investor in energy companies. ESG is really just a way to charge higher fees for market exposure. If something's a dumb idea, if it's not a good idea for your clients, why not just say it's a dumb idea and not do it? If you're interested in learning more about the energy sector and interest rates, then don't forget to subscribe and follow us on LinkedIn and Twitter. Our handles are in the description box below. To find out more about what we're thinking, you can sign up for our twice-weekly blog at sl-advisors.com. We always love to hear from you, so if you have any comments or blog ideas, please leave them down below. I'm Simon Lack. Thank you for watching this video.